At this point, I think we all know what really affects your personal credit. I mean, there's so many different YouTube videos made about this, and even if you just go online, first page of Google, what affects your FICO score? First page of Google will send you to the My FICO scoring site. And these are the people that actually came up with the FICO score. FICO stands for Fair Isaac Corporation. And it tells you right there. There's a chart there that tells you 35% of your FICO score is based on payment history. 30% is based on amounts owed. Another word for that is utilization percentage. 15% is length of credit history. 10% is new credit or inquiries. And then 10% of it is your diversification or credit mix, the way they have it there. There's actually a video that I made, a very well detailed video, and I tell you how to manage each one of these factors. Editor put it right here, somewhere right there. But anyway, this is kind of common knowledge. Everybody knows this, and it's very easily accessible. Even if you go to youtube.com, you will see a ton of people talk about what affects your FICO score. They discuss this chart. It's very easily understandable, digestible, and there's even laws that govern personal credit. You got the Fair Isaac Corporation and a few different laws that are out there, Fair Debt Collection Practice, and there's even some other laws, in the medical with HIPAA and all kind of stuff. It's very easily understandable. Now, there's this increase in interest when it comes to business credit, and one thing that I've noticed is people, even if you go online, there's a ton of videos. People talk about how to get business credit, and it's very vague information. And then you can, or not everybody, but I can tell that these people just don't really understand anything about business credit. You have a bunch of people that are just regurgitating a bunch of stuff that they've heard from somewhere else. I'm here to break it down to you and tell you exactly what affects your business credit. I'm here to kind of just kill all the myths and really make this make sense. That's what I do here. If it's your first time joining us today, I appreciate you for joining me on this video. Please make sure you like, dislike, leave a comment, whatever it is, but interact with with me. Let me know what you like about this video, what you don't like about this video. But I'm here to kind of, there's so much myth. There's, a lot of people talking about business credit, credit card stacking, and all of this stuff. And this is some of the stuff that I cover on this channel as well. But today specifically, what I wanted to kind of put a highlight on is what really affects your business credit score. Okay, what really affects your business credit score? By now, you should know that there's 3 major business credit bureaus. Let me just kind of let you know who they are. There's Dun & Bradstreet, there is Equifax Business, and then there is Experian Business. Okay, with Dun & Bradstreet, the most popular business credit score that you've heard before is the Paydex score. Paydex score, you want to look at that, and that's just like FICO, but it's completely different scoring algorithm, and that's what we're going to go over today because it's not that well known. You're not going to go out there and actually just find that information as quickly as I did when it comes to personal credit. What affects your business credit score? Or even we can do a search on what affects your Paydex score, and you will get so much very vague information about this. There is not just a clear chart. There is not a clear, let's see here. What affects your business credit score? Your FICO score. There's just a bunch of articles that go deep into a bunch of mumbo jumbo that just leaves you clueless. Like, like Shreddy? It doesn't really make sense. It's not clear. Because again, when we go to your FICO score, boom, right in your face. This is it. There's the Fair Credit Reporting Act that tells them how to govern and how to report when it comes to personal credit. And I emphasize that because I want you to know that there is no laws when it comes to business credit. You know how we have, let me make it make sense why this is a big deal. You know how in the personal credit world, there's credit repair. Credit repair is a process where if you have negative items in your credit report, you can go through a dispute process where how those items can be verified. And all of this is executing the law in place. These are all written in the Fair Credit Reporting Act. These are things that the credit bureau has to follow. One of them is, any information on your credit report that is reported has to be 100% accurate, 100% verifiable. So that's one of the angles that we use in the credit repair world. I do credit repair as well. That we help people, if anything being reported is one number, one letter off, then it's not 100% accurate. It's not 100% verifiable. One of the things it says on there, if a creditor or a collection company is going to be placing any negative item on your credit report, that they must send you notice of them placing that item on your credit report. In addition to that, you can request validation, meaning that you can say, hey, prove that you know whatever you're reporting is actually accurate and valid to 100% accuracy based on the fair credit report. All of this stuff that I'm talking about does not exist in the business world. In essence, if you have bad business credit, you're just screwed. I mean, honestly, there's nothing really that you can do. You can dispute it if you want to. They don't even have to respond. But nevertheless, that's not what we're here to talk about today. I'm here to make it make sense. I'm here to explain to you exactly, to the T, what these business credit bureaus look for in order for you to have good, perfect credit, okay? So, by the way, if you don't know, this video is brought to you by Pennington Consulting Group, where we always say our goal is to help you reach your goals. So if you're looking for some funding, if you're a business, if you're looking to start, grow, or even expand your business or in need of some funding, you want to go ahead and click the link in the description below and visit us at Pennington Consulting Group. In addition to that, if you're looking to start your own business loan agency, this program is also brought to you by Broker Solutions Academy. And what we do is we help loan brokers understand and simplify the various funding products that are available in the marketplace so they can properly serve their clients, stop the endless confusion and self-defeating pointless rat race they're currently in, and grow their business while maximizing profits by teaching them how to become a real business loan broker, not just a glorified referral partner. So definitely there's going to be a link in the description. We've worked all year long to really package this program, and it's the most comprehensive loan broker training there is. Guaranteed you're going to be successful, especially if you're going to be having me as your coach, okay? So definitely want to check the links in the description. In addition to that, if you're interested in some of our media services, we offer YouTube editing services. I have my team. You see how great these videos are. Come on, okay? You look at our website. If you look how good those websites are. And look at your website, okay? So if you're interested in having us work on your website, if you're interested in having us work on your YouTube, or even get your social media game just right, you want to go ahead and reach out to us. There's going to be a link in the description on how we can partner up together to help you grow your social media presence, your web presence, so you can position yourself for success, as I always say. So anyway, boom, right here. I'm going to throw it right in your face, and I'm going to tell you exactly. This is based on years of experience. I've actually talked to some people that are in the business credit reporting world, and they've explained all of these things to me, and I'm sitting here and I'm going to tell you exactly what do these business credit bureaus assess. What do they evaluate? Let's make it make sense, okay? Now, the number one, this list here is not in list of importance or whatever it is. It's kind of scattered around, but number of number of trade experiences, okay? So now, this is not the number of trade lines you have per se, but the number of experiences that you have. You know, with business credit, there is such a thing as like net 30 accounts, net 90 accounts, net 60 accounts, accounts that you can, you know, and a lender will extend credit to you, you buy something, and then you pay it off within that certain period of time. So when they're talking about payment experiences, is how many of those experiences have you gone through? You know, when you're talking about those net 30 accounts, or even, it's like, look at it as, this sounds funny, but how many dates have you gone through? You know, how many of these net 30 accounts have you used and paid off? You know, how many credit cards do you have? You know, how many, these are all, there's number of trades. I should actually put a comma here. There should be a number of trade lines, I should say, and the number of payment experiences that you've been reported with your business credit profile. It's a little bit different, you know. Outstanding balances. Now, this is the thing about this outstanding balances, because in the personal credit world, we have what we call is utilization percentage, or amounts owed, if you want to call it. And in essence, the higher your utilization is, the more maxed out you are on your credit card. You know, if you have a $1,000 limit credit card and you're at $900 balance, you get a hit on your credit. So I always say this, that, you know, banks only lend money to people who don't look like they need money. So you have to maintain low balances. You have to maintain low utilization in relation to what the limit is in order for you to benefit of what this 30% toward FICO evaluates. With the business world, it's a little bit different. Believe it or not, you actually benefit from having high balances. You look like you can manage more debt. It's so weird. I don't even know how that works, but you know, this is, you got companies, a number of these major companies basically survive off of credit. Okay, I mean, look at a company like Walmart, Target, you know, Kohl's, whatever it is. they're not paying their inventories in cash. Or whatever services that are being offered, they're not paying them in cash. Matter of fact, they don't even pay until 2 or 3 months after the services are rendered, or after, the products are delivered, or whatever it is. So the more money they're able to manage, the more debt they're able to manage, the more they benefit from what they have. Now, in relation to income, it does affect you, because there is a point where with Dun & Bradstreet, most of these business credit reports, you can't submit financial statements. So if you have $5 billion in debt, but you're only making $1 billion in revenue, then yes, that does hurt you negatively. I guess you can look at that as like the utilization thing as well. But the main point that I want you to get by this factor that I'm discussing here is you are not really hit so much based on utilization. They really look at how much you're able to manage, and they take that into account, and they do some assessments and analyzation based on how much that company actually generates in revenue. And you can submit your income documents with business credit completely different in the personal credit world. Matter of fact, there's a law that says that they cannot count income as it pertains to your personal credit. Literally, you can be broke and homeless, and you can have an 800 FICO score. That's how it is. That's what the law says. They cannot use income, because if you think about it, if they used income, then everybody, only the 1% would have good credit score. But in the business world, there's no law, there's no rules, and they can use income. They can use the business's revenue. They can use the business's net income in order to evaluate that business credit per se. So it's a little bit different. Payment habits. This kind of comes down to, how much do you carry over a balance? Believe it or not, and I've seen this happen before. You have a net 90 account. That means that the vendor will allow you to buy stuff for $2,000-$3,000, and they give you 90 days to pay that off. The sooner, if you pay it off like within 30 days or within 60 days before the 90 days is up, you get more points for that. You get credit for that. They measure these things, okay? So it's kind of really weird, because they want to see how proactive you are as far as keeping those balances low, how proactive you are as far as going out there and borrowing more money and keeping high balances and paying them off, increasing the revenue of your business, increasing the profits of your business. That's what all of this is evaluating, and it's all kind of put into this algorithmic system, I should say, in order for you to kind of be able to assess basically where you stand. Credit utilization, that's very similar to personal credit, but I will tell you that again, it's not that big of a hit. With personal credit, 30% of your credit is based on utilization. With business credit, it's not. It's a very small percentage of your credit is based on utilization. And actually, like I said, really, your balances, the higher they are, they don't have that big of a hit on your credit. Matter of fact, even the more payments you make on that credit card will go ahead and benefit your payment experiences. So now you need to maintain reasonable utilization. You don't want to continuously just carry over a high balance throughout the whole way. I would suggest that, don't go over 50%. Sometimes go over 60%, that's fine. But with personal credit, I always tell people, I have a 30-50 rule. By the way, watch the video that I recommended earlier. It's going to be right here somewhere. Oh, the video that I made is not as clean and as proper as this video. I wasn't using this amazing camera, but really good content where I talk about the 5 things that affect your credit, but I don't just talk about it. I tell you how to manage each one of these factors. It's critically important that you understand how to manage each one of these factors, because you know what it is, but how do you manage each one of these factors? How do you make sure that you always have good credit? That's what that video really covers. Trends over time. So this kind of notices, your trends. It sees, if you're a seasonal business, there's some businesses out there, there are only summer businesses. You have accountants that only work 3 months out of the year. So usually during the first 3 months out of the year, they make really good revenue. They have a lot more activity when it comes to their business, and then it's done. There's nothing. You got businesses that are, in Florida or whatever it is, or, that are only summer based businesses where during the winter times, then they're not making any money. So this is something that they do look at. And you will notice with these type of businesses, during their on seasons, that they tend to maintain good credit. Then during their off seasons, then they're not going to be able to get that much access to funding as possible. And this kind of leads me into, how do they know? You might be, sure, what are they just like Miss Cleo, and they know? Well, there is such a thing called SIC code. SIC code is something that is only used in business credit, by the way. But every single business has its own code, okay? So construction business has a different code than real estate businesses. Let me see, for businesses. Restaurants, different types of restaurants. They all have different types. Here it is. And this is all classified by the government. And you can see I went to sec.gov. It's not like I went to some weird site. And as you can see, these are the business code. There's different classifications for agricultural business. You know, the code is 100. You have this code right here, 200. Forestry is 800. Metal mining is without. So the business credit algorithm utilizes this code on this, you know, in order to kind of see the business trends, and then also the demographic and all of that. We're going to talk about that here in just a second, but this is how they know the specific business trends. A construction business is not going to be that busy during the wintertime. They know that, okay? So they kind of, you know, assess that business facts and oils. What the heck is, okay, I see what they're talking about, textiles. But as you can see on this website, there's a ton. I can continue going on and on and on and on and on and on. There's all these different codes. There's all this different stuff. As you can see on here, it kind of goes on and on. But let's get back to this. So trends over time, this is how they kind of know. And they will see based on the financial statements that you submit. As I said before, with business credit, they allow you to submit financial statements to them. Moving on, number of inquiries. Again, this right here is very exact and similar to personal credit. Goes back to my old joke. I always say this all the time. Banks lend money to people who don't look like they need money. So if you have a lot of inquiries on your credit report, personal or business, you're going to tend to have a low score. You're going to be considered to be what is called a high risk borrower. You know, they do look at public records, frequencies, and dollar amounts. You know, you might want to ask, okay, what is in a public record of a business? Well, there is UCC filings, there is maybe liens, because there is some lenders that do not report, okay, but they do file a UCC filing. You know, UCC filing is kind of like a lien, you know, first position, second position. They look at who are all the owners of the business. These are all the things that they look at in the public record. You know, how much asset that the business has, you know, as far as real estate, that's all public record. Demographics, such as, you know, years on file. You know, they look at how long have you been in business. You know, that is something that is looked at in the personal credit, you know, the length of credit history. So how long have you been in business? Most businesses fail, you know, as you guys know. So they usually, what is it? There's actually statistic that says most businesses fail. This is actually failure rate. This is actually something that is monitored by the government, SBA and all of that. So they look at this. According to the U.S. Bureau of Statistics, this isn't necessarily true data, whatever. Especially 20% of businesses failed during the first 2 years. They opened 45% during the first 5 years, and up to 65% within the first 10 years. So they look at this, and of course, clearly, your score is not going to be as good if you're a very new business. And the more seasoned your business is going to be, the more they're going to start increasing your business credit score. This is how they look. You know, they measure based on demographic, and we just talked about UCC code, a CIC code, and then also the business size. How do they evaluate the business side? They look at a few different factors. They look at the revenue of the business, the net profit of the business, the number of employees of the business, and how much the business is actually, you know, making. So these are all the factors that is looked at in order for you to see exactly what a business, in order for them to generate a business credit score. Now, I made a very detailed video on how to start building business credit, because again, I don't want you guys to get confused. There's just so much information out there, and sometimes too much information is just confusing. So there's a very thorough video that I created on how business credit can be built, and I literally clarified. I make it very simple and digestible for you to understand. You want to watch that video right after video. I appreciate you. Like, dislike, subscribe. I'll see you in the next video.